Greetings, it is time for another video in our CrashWatch series of videos, and we begin with the S&P 500, which is again in this managed decline. It seems that the Federal Reserve is in fact manipulating the market to do a managed decline because by making it decline slowly, they reduce the amount of economic stress. However, this is direct intervention into the free market system, and on principle, this is not how things should manifest. Of course, they cause the distortions themselves, as I often talk about on this channel, with their very stop-start quantitative easing, as well as the nature of money printing they do, concentrating in just treasuries and MBSs and ignoring everything else. So the S&P 500 continues to make lower highs and lower lows, as we see over here, and it's still in a managed decline. It is not in a corrective state, as we can see from the VIX futures, which are still heavily in contango and not depleted in that sense. So we go to the VIX futures chain. So you can see here the VIX futures, and it's a very steep curve downwards. The percentage contango is 9.46% between the front month and the second month, and the front month is going to be over in a couple of days. But even between the January and February futures, it's already 4.08, which is pretty high for the contango between months 2 and months 3 before month 2 becomes month 1. And remember, as I said in the previous CrashWatch video on November 13th, the VIX futures are in a state of corrective energy dissipating because VIX futures can stay elevated only for so long before they fatigue, and investors just can't pay a premium for protection on the S&P 500 anymore. That protection takes the form of S&P 500 puts, which is what makes the VIX price rise as well as the price of VIX futures rise. So when they can no longer hold their breath, the VIX futures effectively exhale, and we're about halfway through that exhale process right now. I'll go back to this clip from my November 13th video for an explanation. And this is a one-year chart of the VIX index. The higher the VIX index is, the more severely the market is correcting, because the VIX is a mathematical calculation of how much people are willing to pay for protection on the S&P 500. That protection takes the form of put options on the S&P 500, protection from it going down, of course. And there was a spike in May, as you can see here, and then a fall, meaning people have become less fearful and more complacent. And then another spike, meaning that a correction was occurring. The median for the VIX longer term is usually around 19 or 20. Therefore, when it's above 30, that means the fear level is pretty high and the market is correcting. When it drifts back down from there, that means the market is rising from the recent correction. It took a lot of time to muster the force to get back to 30 or so, as we can see. And the corrective forces attempted to break down the walls of the fortress for a good month, September and October, let's say. Then it ran out of energy and has to go back and regroup and muster more energy. That takes some weeks. That's why I believe that ultimate bottom of the S&P 500 certainly cannot occur in the next 6 weeks or so, despite the Federal Reserve tightening and all the Fed funds rate hikes that the Federal Reserve has done, which would take some months to work their way through the system. So the next attempt might be in January or February. So as we can see, my prediction from November 13th was correct because the correction is not something that could have happened between November 13th and maybe the middle or second half of January, as I said. So this will continue to be in a state of exhale with high contango until perhaps the third week of January approximately. Then things could get choppy because the VIX futures are settled down, people are complacent again, and the market can make another push towards a correction with the VIX rising a lot and the S&P 500 making new lows. So we go back to the S&P 500. Now, as I've often said, I expect the final bottom to be in the low 3,000s. That should happen in early 2023. If it doesn't happen by then, it may never happen because then the window of a correction has passed and then the correction bottom is at a higher level here because earnings will have caught up. Remember, technology is making corporate earnings accelerate, and ultimately the earnings reach a point at which a very high market level is justified just because the earnings caught up, meaning the price to earnings ratio becomes back down to a median acceptable level because the denominator, the earnings, got higher. But the Federal Reserve continues to raise rates and raise very aggressively, and it takes several months for those rate hikes to percolate through the entire economy, 6 to 9 months, and the speed at which they have raised rates is quite high. In fact, rates were not high until September, and therefore another 6 to 9 months after September, which takes us to the March to June timeframe. That is when the full effect of the rate hikes will be felt, and that is assuming they have stopped raising rates. If they raise rates even further, then the ripple effect will be even more dramatic, because the catch-up of the markets to the Federal Reserve's rate hikes will continue to become more severe. And the Federal Reserve raises rates as though they don't know that it takes 6 to 9 months for the rate hikes to percolate through the economy, even though they say that themselves. But inflation has already peaked and is weakening sharply, as we can see from the recent videos on this channel about inflation, such as this one up here in the upper right hand corner. Why would you raise rates when inflation clearly has peaked and has returned back down to a very sedate level? Of course, if one is trying to make the market crash, then the Federal Reserve's actions make sense. It also makes sense when you consider that they don't even necessarily look at the CPI, but they look at the number of jobs, and they assume the number of jobs means inflation is going to be high immediately, even though that doesn't seem to happen in full employment in the modern age for reasons I've explained elsewhere on this channel. Therefore, their only goal is to reduce the number of jobs, which is a very silly way to reduce demand, which presumes that when people lose their jobs, suddenly they and their children don't need to eat anymore. So job reduction is one of the worst ways to try and reduce demand. Demand is far less elastic than job market strength is. But these PhD economists read in a textbook that if you reduce employment, then you reduce consumption, and therefore that's what they're going to go with. But I digress. So the other factor to look at in terms of dark clouds on the horizon is the mortgage rate. So we go there. 30-year mortgage rate. And you can see it was unusually low from when they bought too many mortgage-backed securities and depressed the mortgage rate to an unusually low level. And I say depressed because this caused home prices to rise tremendously, and a lot of people bought because mortgage rates were low. And a lot of Americans are not able to process a two-variable equation. You are supposed to buy a house when mortgage rates are high because the home price will be low. You not buy when mortgage rates are low because the home price is high. I explained that in great detail in this video up here in the upper right hand corner, but a lot of Americans cannot process this two-variable equation, so by buying when rates are low, they set themselves up to be in negative equity for a very long time. And this mortgage rate, while a little bit below the high we saw a few weeks ago, which was in excess of 7%, is still at 6.31%, which is much higher than at any point in the last 10 years, and still more than twice the level of 2021. So this is very negative for home prices, and it will cause the Federal Reserve to resume printing again to a greater degree than before, and probably something broader than mortgage-backed securities. So the Federal Reserve should not be tightening at all. They printed in a very narrowly concentrated manner, but now they're tightening again, causing more distortions and swings across the economy and destroying decision-making across the economy. But this is very bearish for the S&P 500 in any event, and this only starts to affect the housing market after it's been high for a certain amount of time. When mortgage rates are this high for just a day or a week or a month, nothing happens. But once it is several months, then ultimately buyers evaporate and prices go down, and people become underwater and upside down and in negative equity, whatever term you want to use. It's the same thing. The mortgage balance is worth more than the value of their home, so they have negative equity versus positive equity when the gains on their house are collected by them on a leverage basis. So this is where we are in the market with the S&P 500. Again, I do not expect things to get choppy until well into the second half of January based on where the VIX futures are in the cycle, but then things could get rocky based on all of the factors that I've mentioned. I hope you found this video to be informative, and if you like this type of content, I encourage you to subscribe to this channel. Thank you very much for watching.